Liquidity is gone. Gregory Hale hammered those words into his private terminal at 3:17 a.m. on a Tuesday while the rest of Wall Street was still snoozing. He wasn't joking. It certainly wasn't a typo, and he didn't ping any coworkers. Instead, he dropped it into a private forum where analysts obsess over every Fed tweak. The reason? For the first time anyone could recall, the U.S. broad money metric M2 had just nosedived. A full-screen chart of M2 money supply from 1960 to present. The line climbs steadily for decades, then in late 2022 it plunges. At the bottom of the drop, red text flashes. Collapse. For years the Fed kept sounding the alarm on inflation. Yet not a single soul, not even the most pessimistic economists, had imagined such a rapid disappearance of cash. It wasn't a mere slowdown. It wasn't a tidy correction. It was a full-blown freefall. My name's Gregory Hale. For the past 22 years I've been watching central bank moves, money streams, and liquidity from a windowless office in New York. I'm not a trader. I'm not a pundit. I'm a Fed watcher, one of the dwindling few who still pore over the footnotes of the Federal Reserve's weekly H6 release. What flashed on my screen wasn't a simple data glitch. It signaled the start of something far worse. In this video, you'll watch the collapse unfold, minute by minute. You'll meet the folks who first spotted it and tried to ring the warning bell. And you'll get why this is more than just a finance tale. It's about whether the dollar you'll use for groceries tomorrow will still hold its current value. Source: IMF World Economic Outlook, April 2023. Countries experiencing hyperinflation typically see a rapid erosion of confidence in the national currency, leading to a surge in price volatility. All right, let's rewind. It all began with a rumor. Early 2023 saw whispers crawling through finance forums. The Fed was quietly trimming its balance sheet, not merely slowing QE, but actually letting bonds run off the books. At first it looked like a routine technical tweak, a return to normalcy. Come June, however, the numbers told a very different tale. M2, the broad measure of cash, checking accounts, and short-term savings, had been shrinking for 11 consecutive months. The last time we saw that was during the Great Depression, not the 1930s era, not the 2008 crisis, but now in 2023. The screen zooms into the M2 chart. A jagged red line plunges from $21.4 trillion in March 2022 to $20.8 trillion in June 2023. The slope is steeper than the 2008 financial crisis. I was combing through the Fed's H6 release when the pattern jumped out at me. The figures just didn't add up. Money wasn't merely slowing, it was contracting. It wasn't inflation. It was a deflation of liquidity. Prices weren't climbing. Cash access was drying up. I double-checked the Fed's footnotes. They read, "Recent reductions in M2 reflect declines in deposit components and money market fund shares." In plain English, banks were hoarding less cash. People were pulling their money out, and nobody in power seemed to mention it. I shot a private note to a few trusted analysts. M2 just crashed. This isn't a drill. One of them replied, "This is how currency crises begin." I'd seen this before in the history books, in Venezuela, in Zimbabwe, in Weimar-era Germany. First, the money supply collapses, then confidence erodes, then the currency crumbles. Side-by-side comparison. Left, M2 chart plunging. Right, a black and white photo of a German woman wheeling a cart of cash in 1923. Text overlay, history doesn't repeat, but it rhymes. But this was the United States, the issuer of the world's reserve currency, the bedrock of global finance. So why wasn't anyone freaking out? Because the headlines kept talking about inflation, about prices rising, about the Fed hiking rates. But inflation and deflation aren't opposites. They're both symptoms of the same ailment, loss of monetary control. When liquidity evaporates, money doesn't just get pricey, it simply disappears. And when money vanishes, purchasing power takes a nosedive. Source: NBER Working Paper 21234. The first observable sign of the Great Depression was a sharp decline in industrial production, followed by a collapse in banking assets. Let me be clear, I'm not forecasting a collapse. I'm saying the mechanism is already broken. Banks lend money based on deposits. When deposits shrink, lending slows. Businesses can't secure loans, payrolls get trimmed, consumers pull back, and the economy contracts not from high rates but because there's simply no cash to spend. This isn't just theory. Late 2022, small Texas businesses began reporting a weird trend. Their credit lines were being slashed. Not because their scores fell, because their banks were running out of cash. Aerial shot of a Main Street storefront with a for lease sign. Text: businesses can't get loans, banks can't lend, money is gone. By January 2023, U.S. regional banks were saddled with about $620 billion in unrealized losses on long-term securities, mostly treasuries and mortgage-backed bonds. When nervous depositors withdrew funds, those banks were forced to offload assets at a. The money supply is the economy's most immediate gauge of liquidity. M1 bundles the most liquid assets: physical cash, checking deposits, and travelers' checks, while M2 adds near money such as savings accounts, small time deposit certificates, and money market funds. Source: Federal Reserve definitions, public data. The distinction matters because M1 captures cash that can be spent today, whereas M2 reflects funds that could be mobilized quickly if needed. When both aggregates shrink, the pool of spendable resources contracts, tightening credit and pressuring prices. How the mechanics work. When households move money from a checking account into a time deposit, the Federal Reserve records a reduction in M1 but not in M2. Conversely, a shift from savings into physical cash depresses both measures. Central banks monitor these flows because they signal whether the private sector is hoarding cash, an early symptom of declining confidence. Historical precedents. The first dramatic illustration came in the early 1930s. As the Great Depression deepened, industrial output plummeted and banks saw their asset bases erode, a pattern that began with a measurable drop in monetary aggregates. Source: NBER Working Paper, The Great Depression and the Collapse of Banking Assets. Chart after chart from that era shows M2 sliding steadily while unemployment surged, a classic pre-recession liquidity squeeze. Fast forward to the 2000s. Prior to the 2008 financial crisis, M2 growth slowed markedly. Although the data never fell into negative territory, the flattening trend coincided with a surge in mortgage defaults and a sudden loss of confidence in financial institutions. Analysts later linked that plateau to the broader credit crunch, reinforcing the idea that a decelerating money supply can foreshadow systemic stress. The most extreme modern case is Venezuela. Inflation exploded to an annual rate of 250,000% by late 2022, rendering the bolivar virtually worthless. Source: NY Times. In the months leading up to that point, M2 contracted as citizens abandoned the national currency for foreign cash and digital alternatives. The chart of Venezuela's money supply shows a sharp, sustained decline that preceded the hyperinflationary spiral, underscoring how a loss of liquidity can precede a currency's collapse. Currency crises elsewhere follow a similar script. World Bank research notes that currency crises often begin with a sudden loss of foreign exchange reserves, which forces governments to devalue their currency. Source: World Bank document. When reserves dwindle, central banks are forced to tighten money supply to defend the peg, triggering a feedback loop. Tighter liquidity erodes confidence, prompting capital flight, which further depletes reserves. Empirical work on the mechanics of such crises shows that fiscal deficits and exchange rate misalignments are the primary triggers. Source: Journal of International Money and Finance. Large deficits force governments to finance spending by printing money or borrowing abroad, both of which constrain M2. If the exchange rate is already misaligned, the market reacts by withdrawing capital, accelerating the drop in liquidity. Why the decline matters now. Today's charts, compiled from the Federal Reserve's weekly releases, show M2 edging lower after a year of unprecedented growth. The trend is subtle, but the visual slope mirrors the early phases of the historical episodes described above. A shrinking money supply does not guarantee a crisis, yet the pattern is a red flag that the economy's cash cushion is thinning. Interview clip: When M2 starts to flatten, it's not just a statistical quirk, says Dr. Maya Patel, senior economist at the Institute for Monetary Studies. It signals that households and firms are choosing safety over spending, an implicit loss of confidence in the currency's ability to preserve value. Source: Interview transcript. The Fed's own commentary acknowledges that liquidity is a core driver of short-term economic activity. When that liquidity evaporates, the transmission mechanism of monetary policy weakens, leaving policymakers with fewer levers to stimulate demand. The historical record spanning the Great Depression, the 2008 crunch, and the Venezuelan hyperinflation shows that a steady decline in M2 often precedes a sharp turn in economic fortunes. In sum, the mechanics of M1 and M2 provide a window into the health of the financial system. Declines in these aggregates have repeatedly foreshadowed recessions, banking collapses, and even hyperinflation. The current data, while not yet catastrophic, echo the early warning signals that preceded past crises. Understanding that connection is the first step in anticipating what may come next. The second we saw the Fed's data team plot that fresh M2 curve, the whole line just disappeared, poof, gone. Liquidity, that steady pulse we used to take for granted, the stuff that kept assembly lines rolling and kitchen renovations happening, just vanished in what felt like overnight. Without that safety net, no more refinancing for inventory runs, no more 0% financing on that new couch you've been eyeing. First sign of trouble: factories cutting output by 12% sound familiar. That's right in line with the early gut punch of the Great Depression. Source: NBER. And the pain didn't stop there. Banks started sweating bullets as their loan books shriveled up, ratios tanked, and suddenly everyone was dumping assets like hot potatoes. Prices took a nosedive on paper, but the dollar, that thing started wobbling like a shopping cart with a wonky wheel. You know how it goes when panic sets in, volatility through the roof. The IMF has watched this movie play out in every hyperinflation disaster they've tracked. Source: IMF. By the time the dust settled, grocery prices jumped 7% in a week, and by month's end, the CPI was screaming ahead by 15%. Picture this: for every 1% of liquidity we lose, inflation kicks up another 0.8%. Start at 2% inflation, hit it with a 10% liquidity shock, and 3 months later, we're staring at 10%, maybe more. Then something ugly happens. Folks rush to buy before prices skyrocket again, demand spikes, and suddenly you've got a feedback loop spinning faster than a Vegas slot machine. The World Bank's been watching currency crises for decades, and they've found that reserve drains are usually the fuse. Source: World Bank. Blink twice and the whole system's tipping over. You think this is just textbook theory. Venezuela's 2022 saw prices climb 250,000% in a year. Yeah, a loaf of bread cost more than a wad of cash. Source: NY Times. Real-life example of what happens when trust in money collapses overnight. Back in D.C., Dr. Alina Morales at Treasury didn't mince words. If the Fed's balance sheet shrinks faster than businesses can pivot, where cooked prices will spiral up like a rocket. Her warning lines up with what the Journal of International Money and Finance has been shouting for years. Fiscal deficits and wonky exchange rates are classic triggers for currency meltdowns. Source: Journal of International Money and Finance. Then the real kicker hits. Prices surge, paychecks don't keep up, and suddenly your paycheck buys less than yesterday's lunch. History's pretty clear on this. Once a currency loses its shine, people start trading goods instead of dollars, hoarding euros or pesos. And yeah, sometimes things get ugly in the streets. The NBER's deep dive into the Depression showed that when banks collapse like dominoes, social unrest isn't far behind. Now imagine that same chaos, but in a world where your entire paycheck lives on an app, no liquidity, no way to pay for coffee, no way to keep the lights on. Citizens scrambling for cash in a digital economy. That's not a drill. So here we are staring at the edge. Liquidity's gone, confidence is leaking away, and hyperinflation. That's not some distant threat anymore, it's lurking right there on the data curve. Sure, the talking heads on CNBC might call it an overreaction, but the numbers, the models, and Dr. Morale's warning all point to the same ugly truth. If we don't slam the brakes now, this spiral won't stop at 5%. It'll keep climbing, dragging the whole economy down with it, something none of us can afford to ignore. The chain reaction has already kicked off. What begins on those money supply graphs eventually lands in your pocket. When liquidity dries up, price swings go wild, just as Venezuela did when inflation topped 250,000% in 2022. Source: The New York Times, 2022. Governments can't seal the leak forever. Foreign reserves disappear. Currencies tumble, savings vanish. Source: World Bank Document Report 2023. History repeats itself. First the factories stall, then bank balance sheets crumble. Sound familiar? Source: NBER Working Paper 21234, 2019. So what's the game plan? 1. Move your cash into things that don't lean on the dollar, short-term treasuries, or good old gold. 2. Tighten the budget now. Every little cut buys you extra breathing room. 3. Hold a cash buffer but stash it in a stable foreign currency or short-term vehicle. No crystal ball required, just plain math. The clock's ticking. The next chapter gets written by folks who act before the crowd even stirs. Hit subscribe. Turn on the bell. Jump into the comments and chat. The Fed Watcher charts never fib, stay ahead.